the impact. You see the impact of this, that without discounting our cash flows, the project is paying in 3 years and 11 months. But if you consider the effect of time value of money, the project will pay in 4 years and 9 months. So that is how we do a modified. What you only do is to discount or to accumulate the discounted cash flows. I don't know if you have a question. Any question, friends, on this?
So excuse.
Yes.
You see, if you consider the time value of money, it
Mm.
changes the payback period. So
Yes.
between the two, either
Mm.
modified or not modified,
Mm.
which of the two is I can say real.
I think it's for very fast screening, you can use the normal payback. But if you want to make a right decision, it's better to use a modified payback. Is it okay, friends? Any question? We are leaving this part. That was part 2, which is a investment appraisal techniques. Any question, friends? You're not giving me answer.
May continue.
Okay. Yes, please. Uh, someone is saying we ended the class at 2. Okay.
So
Someone
that's
is having
nothing yet,
another.
you see.
It must go at 5.
It's not easy. Sitting for 4 hours, 5 hours, 8 hours is not easy.
Yes, sir. Yes, we should stop class at 8, at 2 for sure.
Unless you are very strong, you have taken enough sugar. Otherwise, not easy. So let's look at number 3 of our discussion, incorporating. But I said I wanted us to first to finish up, maybe because tomorrow I want us to finish this part of investment, incorporating inflation and the tax in the investment appraisal. Incorporating inflation and tax, I think that's number 3 in our discussion point. Incorporating inflation and tax in investment appraisal. Now, when there is inflation in the economy, you must adjust your cash flows with inflation. Before evaluating the cash flows, or if there is inflation in the question, you must adjust for the inflation in your cash flows. So, effect of inflation, that's the number 1. Effect of inflation. And you can say that when there is inflation in the economy, the cash flows should be adjusted with the effect of inflation. As long as you have inflation in your question, you must adjust your cash flows with the effect of inflation. And when you are adjusting, you need to adjust both the discount rate and the cash flows. Adjust the discount rate and adjust the cash flows.
Come back
So-
on that statement. Otherwise, you
When-
have inflation in your question. You have it too.
When there is inflation in the economy, the cash flow should be adjusted with the effect of inflation. So as long as you have inflation, it means you must adjust your cash flows. Now, maybe to understand this, let's look at some of the terms used. The terms used here. Maybe it can help us to understand. Number one, we have what called a nominal cash flows. Nominal cash flows or money. We say nominal, sometimes they're called money. Money cash flows. Now, when we say nominal, they are the cash flows after adjusting for inflation. We call them nominal cash flows. So these are cash flows after adjusting for the effect of inflation. After adjusting for the effect of inflation in your cash flows, then we call those cash flows nominal cash flows. That's the first term. Term number two is what's called a nominal rate or money rate. Nominal or money rate. So it is the discount rate after incorporating the effect of inflation. After you have adjusted your discount rate with inflation, we call it a nominal rate or we call it a money rate. So nominal cash flows should be discounted using nominal rate. That's a simple note to make. Nominal cash flows should be discounted using the nominal rate. When you are discounting your cash flows and you have adjusted for inflation, your nominal cash flows should be discounted using a nominal rate. So look at your rate. Is it a real rate or it's a nominal rate? The question should be specific. If the question is silent, you assume it is a nominal rate. But if a question assumes it is a real rate, then you have to adjust and get a nominal rate.
Come back again, Sauni. That notice.
We are saying, if you have adjusted your cash flows and you have nominal cash flows, then when you are discounting those cash flows, you should discount them using a nominal rate, a rate that incorporates inflation.
Okay.
Then we have what called real cash flows. So these are cash flows which are in the current terms. As long as your cash flows are in current term, we call it a real cash flows, meaning they are not adjusted for inflation. They are not adjusted for inflation. Those cash flows are not adjusted for inflation. In that case, you have real cash flows. Now, if we have real rate, it is the rate which is in the current terms, meaning it is not adjusted for inflation. You have a current rate which has no inflation effect. So still, if you have real cash flows, another note, real cash flows should be discounted using the real rate. When you are discounting your real cash flows, those cash flows that do not have any inflation, you should discount them using a real rate. So what do you need to look at? As long as you are seeing inflation in the question, then also look at your rate. Is it a real rate or is it a nominal rate? I said if the question is silent, you assume that it is a nominal rate. That's the assumption we always make. Relationship between nominal real and the inflation rate. Relationship between the real rate, the inflation rate, and the nominal rate. So this relationship is given by Ivan Fisher's formula. The relationship is given by, is it Ivan Fisher? As below. So we have 1 plus I is equal to 1 plus R into 1 plus H, where I is the nominal rate. I is the nominal rate, R is the real rate, and H is the inflation rate. So you can from here determine any of what you want. For example, if I want to get a nominal rate, my nominal rate will be equal to 1 plus R into 1 plus H minus 1. I can get a nominal rate. If I want to get a real rate, it's going to be 1 plus I minus 1 over 1 plus H. I get, so whatever you have, you can adjust to get either nominal rate or you can adjust to get a real rate. So it depends on what you are answering. So you can adjust and get a nominal rate, you can adjust and get a real rate. But my emphasis is that once you have inflation, adjust. If the rate is in real, adjust to get a nominal rate. If your cash flows are in real term, but the rate is nominal, adjust to get a real rate to discount your cash flows. Please be very careful to look at that in the question.
Excuse me, sir.
Yes.
When we look at the relationship between nominal, real, and inflation rate, we can see that when we try to get the nominal rate, it seems that the I which was representing maybe the interest rate, it seems that it is not there when we calculating the nominal rate.
What about here? This I, this one?
No, the other one, I plus E.
This
the
one?
other one. No. Up. Yes, this one. Yes.
Where? Which one? This one?
Yeah. This
It is
one. E.
It is one.
That one.
1 plus I.
1 plus I. They are both formula for getting the nominal rate.
Yeah, it will be 1 plus real rate times 1 plus inflation rate.
Why that E is not there?
Which is the nominal rate?
Yes, sir.
Okay.
From the formula of the above, Irwin Fishers, it is the capital I plus small I.
Yes.
This is 1.
Yeah.
1. This is not I, it is 1.
It is 1, not I.
Listen, I'm confused.
It is 1.
Okay. Thank you.
Okay, it is 1. So that is the Irwin Fisher's formula. Please look at the question clearly and identify whether you are dealing with real or you are dealing with the nominal cash flows, real cash flows, nominal rate, or dealing with the real rate. Then I think another part we are looking at is incorporating tax. Incorporating tax in investment.
Excuse me.
Yes.
I think we should give us like an example to understand more the incorporation of inflation.
I thought we are going to look at it after this. We look at one example that combines all of this.
Okay.
Yes.
So let's look at incorporating tax in investment appraisal. How do we incorporate tax? Now, as far as tax is concerned, it has got 2 important effects on your investment decision. First, when you generate profit, you must pay tax from the profit. That's the first effect. As long as you have generated the profit from your operation, you must pay tax from that profit. That's the first effect. The second effect of tax is that depreciation, if depreciation is allowed, it reduces the amount of tax that you are supposed to pay. Meaning, if you are depreciating an asset, you will enjoy a tax saving on the depreciation, which is a benefit. So as far as depreciation is concerned, or as far as tax is concerned, you are going to look at it in those two aspects. The cash outflow, which you are going to calculate from the profit, and the tax saving, which is a benefit from the depreciation of asset. So we can say that tax has two effects on the investment appraisal. That is, number one, corporate income tax or income tax. Income tax to be calculated from the profit generated, which is a cash outflow. So if you generate profit from the operation of the project, you must calculate the tax, and that is going to be a cash outflow. So what is important on this is to know the timing of your tax. When are you supposed to pay tax? Are you paying in the same year, or you are paying a year in earlier? So look at the timing of your tax, whether it is in the same tax period or you are paying a year in earlier. That is number one. Effect number two on tax is the tax allowable depreciation. The tax allowable depreciation. So depreciation is an allowable expense for tax. This reduces the amount of tax to be paid, thus creating a tax benefit or saving. Which should be recognized as a cash inflow. So whenever you are analyzing tax, you are going to analyze tax in the two aspects that we are talking about here.
What do you mean by is an allowable expense for?
For tax. Huh? I didn't finish it. It's an allowable expense for tax. It's an allowable expense for tax. So if you depreciate an asset, that depreciation is allowed for tax. So because you are allowing it for tax, you reduce the amount of tax that you are going to pay. And therefore, you are going to create a tax benefit on that asset. So that tax benefit, you should recognize it. You should recognize that tax benefit in your computation as a tax saving, which is an inflow. Now, when we are calculating, of course, you do the normal depreciation of asset. Let's say, and also the timing here is very important. The timing in part 1 should be the same timing in part 2. If your tax is paid in the same year, even the saving will be in the same year. If the tax is paid in earlier, even the saving will be in earlier. So I'm going to copy the question that we had up there and then add some extra parts to make it now another part of another important. I'm going to copy this question, which we had here.
Why can't we do a past paper type?
We can do. You do have it one? Maybe we can. I can copy it.
Not yet.
I've not also checked, but I can. But it is for simple. We can first look at this. Of course, we shall look at the past paper. Don't worry. As long as you get the idea first. Maybe I can only stop here. And I want to add some parts. Okay. I think it makes now sense. It captures all the information that you need. Maybe someone also wanted to look at how to adjust the other one. The cost of capital is 12% in the current term. I still again add the general inflation. So that is it. I think if you look at through the question, I've changed something, few things. Is evaluating. This information has not changed. Maybe I would have added opportunity cost. Maybe on another example, I can add opportunity cost. So the selling price point is the same. This one has not changed. What I've added is this part. Due to inflation, the selling price will increase by 4%, while the variable cost will increase by 3%. Fixed production costs and working capital will move in the same direction as the variable costs. The allowable tax depreciation for asset is 20%, reducing balance, while tax is paid in the same year. The general inflation in the economy is 6.5%, and this cost of capital is in the current terms. It meaning this is it is a real cost of capital. So because it is a real cost of capital and we are going to adjust for inflation, we shall have to adjust it again. So I want to copy the sum of the data we used here. Here. I want to copy the first one. I think I only need this. Or I may call it my working one. So we can start it now. So still this one, what I'm adding here, I'm adding inflation. That's what I'm adding. I'm adding the price. I didn't copy it. I can copy the price, which is, I think was 500, the price. Now, I add another row which is about inflation. How do I get my inflation? To get my inflation, it will be equal to.
We are unable to copy what you are.
Which one again, sir? Which one?
Oh, the example.
Eh?
Oh, the example.
But the example, I've copied the other one. I've added a few. Okay, this one has also changed. 150, 190. This one has changed to 190. I'm going to 190. This has changed to 140, I think. 140. The other one has moved 110. This has changed to 140. I'm going to share the slides because it is now a big part of the question. But what you are adding in the question, you are adding this like a paragraph here. This paragraph is what you are adding. That's what I've added in this question. Can you continue and then you will copy it later? After
Okay.
sending it,
Yes.
after sending the Excel. So my inflation, that's what I was talking about. My inflation will be 1 plus H, my inflation rate, power N. So remember our H on selling price, inflation on selling price is on selling price is 4%. That's the inflation on selling price. That's what you should substitute here. So it means here I will have 1 plus 0.04, then power this. Hey. That's going to be the inflation on my selling price. So what will be my nominal revenue? My revenues, which are nominal now, because I've adjusted for inflation, I will get the units times the selling price times the inflation.
Can you click on the formula? Yes, they are on inflation.
The formula on inflation, it's the one I've put
Yeah,
up.
yes, click there. Yes.
I've clicked.
Now we want to see in the formula.
Hmm?
You can
The
click
formula is
again. Hey, okay.
Excuse me.
yes, please.
What are we asked to find or to determine?
We
Our requirement.
evaluating the project using
Which one?
NPV, but we have inflation.
Okay.
Then in the second year.
It's the same, it will be power 2.
Ah, okay.
Then working it 2 is variable cost. Variable costs. Now, for our variable costs, still I'm going to copy this. I'm going to copy this. And I'm going to take my variable cost per unit, which is 200. That's the variable cost per unit. Then, inflation on selling on a variable cost is inflation on variable cost is 3%. Please mute. Inflation on variable cost is 3%. So it means here my inflation on variable costs, inflation on variable cost will be 1 plus 0.03 power 1 in the first year, power 2 in the second year, power 3 in the third year. So if I scroll like this, so what is going to be the variable cost, but in the nominal terms? Get the units.
That is mean that it is a nominal variable cost.
Nominal variable costs times the price, the cost, times the inflation. That will be the inflation on the variable, on my variable costs. I can now look at working 3, which is going to be my fixed costs or fixed production cost. But I would still add this as operating cost, but this, since I've already moved fixed production cost. That's my working 3. So what do I have here? I have year 1, year 2, year 3, year 4, and I have year 5 for this. My fixed cost is given is 5,000.
In that example, we don't have to select the relevant cash flow.
We have them because this is a fixed production cost. It is relevant because you are going to incur it in your production.
Sorry?
These are fixed production costs. You are incurring them in your production. They are not normal fixed. These are fixed production costs.
To indicate that is irrelevant.
They are relevant. So this is the inflation. It is the same. Hey, what am I copying?
How the rate of inflation on a fixed cost?
It is the same. They say it is moving in the same direction of variable cost. If you check the information, it says fixed production cost and working capital will move in the same direction as variable cost. It means it's also going to be 3%. Please mute. Please mute. So what do you have as a fixed cost nominal?
No, you write there inflation.
Inflation. Our nominal fixed cost will be this times this. So that is the fixed costs or fixed production costs. Now, the next part we are working is working in number 4. Working in number 4 is working capital. Working capital. So we have year 0, year 1, year 2, year 3, year 4, and year 5. That is the working capital we want to look at. Our investment in working capital is how much? Is it 20? Is it 20? We are investing 20 in working capital. So meaning this, since you are not making a new investment, this working capital is going to remain the same in all years. You will have a working capital of 20. I want you to understand me here. And here you are supposed to recoup. Well, I didn't put a minus here. Hey. I want you to understand me on this part. And we are supposed to leave 20 here at the end. That's what it means in this case. This one, it remains the same, but we are supposed to recover. Now, we are having an...
It looks like each year we will be investing.
For me, I want to ask if in each year we inject
inflation here
for working capital.
Automatically, your inflation is going to affect your... It's going to have an effect in your investment in working capital.
Excuse me, I'm asking, when you present it like
Yes.
that, it looks like each year we'll be investing in working capital.
Okay, let me remove it such that maybe I thought it will make sense to what I want to talk about. Okay. But I don't know whether you're going to follow it in this case. Now, due to investment, because this is what you need. This can you mute? This is what you need to invest. But because of inflation, you will need more money to invest. It means the actual working capital you will need here, it will be this times this. For here, it will be this times this. For here, it will be this times this. And here, it will be this times this. That is the actual investment. If you consider inflation or the changes in inflation, this is the amount that you require to invest in working capital. So what is the incremental investment? Of course, here it's going to be the same. It is this. Here, it will be this. Is it minus? Minus this. You will need 600, and this 600 has come as a result of inflation. Here, you need this minus this. So you will need an additional 618 due to inflation. Here, you will need this minus this. 637, which is a result of inflation. And here it will be this minus this. You have to invest 656 because of inflation. Now, how much are you going to recover? If you add all of these investment in working capital, you will recover this. That's the amount you are going to recover in working capital. Twageze twese hano.
tureka muri iyo formula ya 22 tureba mu ikuye iyo formula ya 2250 510
nafashe this times this inflation rate mwaka wa 4.
No, I think he's asking about the 22,000, the recap.
The recap, the inflation, if you add this plus this plus this plus this plus this, you get this. Chango fate working capital y'umwaka wa nyuma. Investment y'umwaka wa nyuma total. Irakuwa ugomba kulikapinga. Twageze? Ko mutari kuvuga mwasigaye?
Turi kumwe.
So that is our inflation. Then working number 4. Working number 5, sorry, now is the tax allowable depreciation. Tax allowable depreciation. So we have the cost of the asset. Cost of asset, which is 100,000 or 100 million. We have a residual value, which is 10. Our depreciation rate is 20% reducing. That's what we have. Now, if you look at this, we are going to calculate our depreciation on reducing balance. Normal way. So year 1, this is the period. This one is the depreciation. This is the net book value of the asset. And this is our tax saving, or what we call the tax allowable depreciation, but at 30%. So I have year 1, year 2, year 3, year 4, and year 5. Because we are depreciating on reducing, so it means in my year 1, I depreciate on cost. That is going to be 20% times the cost of the asset, which is 100. That is year 1. So what will be the net book value here? My net book value will be 100 minus this. Now, in the second year, because we are depreciating on reducing, I calculated depreciation on the net book value. It will be this times 20%, because we are depreciating on reducing balance. So I calculated the depreciation on the net book value. So it means here I will have 100 minus this. Third year, I'm calculating the depreciation on the net book value again. So it will be this minus this. Fourth year, 20% times this. So I will have this minus this. Mwaka wa nyuma, asset ifite agaciro ka 10. That's the residual value. Mwaka wa nyuma. So meaning, iraba itakaje, we shall have a loss on it. A loss younger of this minus this.
turebe ukuntu mwabonye 20 yo mu depreciation mu mwaka wa mbere. Is not 100 minus 10 times 20%.
When you are depreciating on reducing balance, I don't think so. It should be 100 times 20%. Isn't it so?
Okay.
So last year, I don't know why I'm putting this minus this. It is a loss. So since it is a loss, you calculate a tax saving.
Why do you say it is a loss, lecturer?
Ubona mu mwaka wa kane asset ifite agaciro ka miliyoni 40. Yose. None uri kutangira umwaka wa kane asset ifite agaciro ka miliyoni 40. Ariko at the end asset ugigurishije kuri miliyoni 10. Ifite value ya miliyoni 10. Nuvuga urabo hombi. Seriously?
Nibyo.
Yes.
Yeah. So how do we calculate this? We calculate it on this saving times the tax of 30%. Get this times 30%. This times 30%. This times 30%. And this times 30%. Now, I want to show you something again here. Suppose this asset, if the value ya miliyoni 60 at the end, ikigiye ubugiye kurecognizing a tax payment na gari tax saving, it will be a gain, not a loss. Tumvikanye?
Yes.
So look at it, always look at that.
Lecture.
Yes.
So, if it is a tax payment, why are you calculating a tax saving on loss?
Because the loss is an expense. And because it is an expense, you are going to save tax on it.
Okay. Excuse me, sir.
Yes, please.
On the fourth year, I'm stuck to understand how it is a loss. I can see.
Yanga mwaka wa gatanu, nagari mwaka wa kane.
Ni mwaka wa gatanu gongo. Yes.
Obona mwaka wa gatanu on first utangira mwaka wa gatanu. Asset ifite book value. The book value of the asset is 40. Is this? 40, 960. And it has got a residual value of 10. So are we having a gain or loss on this asset?
Ariko aho ngaho turacyari mu mwaka wa kane nyine kubera ko umwaka wa gatanu.
Ariko utangiye umwaka uvuga this is at the end. If
depreciation y'umwaka wa gatanu ni kangahe?
Depreciation
y'umwaka wa gatanu ko tutari kwibonamo.
Ntago wavuga ngo ugiye kongera ku depreciating abakwaye agaciro ka end y'umwaka wa gatanu. Ntago yongera ku depreciating.
So we need the loss of
30. Kuvuga ibi byose bivuyeho if asset ifite agaciro ka miliyoni 10. No kuvuga iki gihe uba wahombye miliyoni 30 ku iyo asset. Cyangwa ya depreciated na miliyoni 30.
The tax saving is calculated at
30%.
No, those 9.9288 is from.
Fata hano kube 30%.
Okay.
So it seems the closing balance of the net book value for the fourth year is the opening balance of the fifth year.
Yes.
Okay. And the residual value of the asset at the end of the fifth year is 10,000.
Which was given in the question.
Okay. Yeah. Understood.
So that working is also finished. Now,
what do you mean by the 5 loss?
That's to say, in year 5 it is a loss, not a 5 loss. In year 5 you have a loss.
You can put the loss in a bracket.
Uri rwa rugero mwari mwakoresheje rwa 60 ubwo nari izaza ari muri bracket muri tax saving as payment.
Iraba gain. Ariko hano iraba payment. Ntago ari saving ariko iraba payment.
Ubwo iraza muri bracket.
Iraza muri bracket. Tuvuge asset at the end of 5 years ifite miliyoni 60. Hano navuga mwaka wa gatanu nabo ufite gain ya miliyoni 19. Uba ugomba kwishyura umusoro wa miliyoni 5.
5. Okay.
Yeah, which will be a tax payment.
Okay.
So, please mute. So now if you look at that, we still remain with one working. We need the working number 6, nominal. We need the nominal rate. So if we need a nominal rate, please mute so that it will reduce the noise. We need a nominal rate, which is we have our real rate R 12%. We have our general inflation H. Our general inflation H, which is 6.5%. And we need our I. And we said our I will be equal to, if you put in the Fisher's formula, 1 plus R into O times 1 plus
H, then minus 1.
Then minus 1. So we can substitute our I will be equal to 1 plus 0.12 times 1 plus 0.065. Then what we get, we minus. So our I is equal to what?
It is 19.28%.
So 19.
0.28%, or you can use 19.3.
19.3%. Okay, that is our I. I think we have all the workings. What is remaining is now to put in our format. So we are looking at a NPV at 19.3%. So this is year 0, year 1, year 2, year 3, year 4, year 5. So our revenue, that is working number 1. I'm going to copy. I think that is the revenue. Then my variable cost, which is working number 2, I can still copy. Then my fixed cost, working number 3, I can copy. It is here, I think. So my earning before tax, my EBT is here. Remember, the question told us tax is paid in the same year. Our tax is paid in the same year. So my tax at 30%, tax at 30%, I get this times, all right, let me put a minus 30% times this. Because we are paying it in the same year, it's accruing in the same year. So I will have this as my tax. So what's my earnings after tax? Earnings after tax, I will have that. That's the earnings after tax. Now I recognize my tax saving. Which is working number what?
6.
Number 6.
5, sorry. 5.
Working number 5. So I can copy. Since the tax is in the same, even this one will be in the same year. So I copy this. I have this. I can copy it here. I have this. I have this. And I have this. So my net income will be, or net earnings will be these two. Then I have my machine. My machines.
It is investment.
Investment, but we have assets. I have the assets, which is 100. Then I have a residual value. We said we separate residual of 20 here. I have a working capital. Which is a working number 4. So this is how much my working capital, it is here. That's the working capital, because I'll be then I'm going to recover this. So what will be the net cash flows? Net cash flow, I'm adding here the total. That's my net cash flows. Then why is not my discounting factor at 19.3%? What do I have? This is 1 plus 0.193. Then power this. Then I can scroll. Hey, what is wrong? I didn't put a minus. So what will be the present value? I'm getting this times this. So if I scroll, so NPV, my NPV will be equal to, I'm going to sum the total. So minus, so we are rejecting. Telling me the challenge now. Members, what are the challenge in this part? Any question, members? You are not saying a word.
Yeah, for working capital number 4,
It is what?
For the working capital where we've got
is here.
Yeah. So the recovery is at the the starting of 5th year or at the end?
At the end of year 5.
Now we've considered now the increment after 4th year.
Because in the 5th year we are not going to invest. The project is ending. You cannot make more investment in working capital.
Okay.
Yes. Any other question? I've heard someone as if knocking.
Excuse me, sir.
Yes.
I want to understand the idea behind for the working capital. At a year 0, we injected the 20K. Then each year, our initial investment on working capital reduces.
It reduces, increases.
Yes, it is reducing because.
Reba neza ariko. Ubona wano washizemo miliyoni 20. Sibyo se?
Yego.
Mu mwaka wa mbere at the end uraba ukeneye miliyoni 20,600. Nonese yaragabanutse cyangwa iziyongera kubera of inflation?
Ubwo se the inflation iri kwiyongera cyangwa iri kugabanuka?
Inflation iri kwiyongera, niyo mpamvu amafaranga ari kwiyongera. Hano yongeye ubona mu mwaka wa mbere iyongemo 600. Ugomba kongera muri investment wari wateganyije ya miliyoni 20. Mwaka wa kabiri iraba urongera 618 mwaka wa kabiri bitewe na inflation.
The problem
twavuga ngo nokongera mwarimu.
None se ni iki?
Cyangwa na vari ya cost.
Ariko niki kitumye aya mafaranga yiyongera? Novuga wateganyije ngo project ikeneye miliyoni
20. Inflated amount.
Tuvuge mati oshaka kuchira aya mafaranga to buy materials or stock.
Yes.
Ariko kubera inflation uzakeneye amafaranga menshi kuruta iyo wateganyije. Sibyo se?
Yes.
None se ari kwiyongera ari kugabanuka?
Inflation. Hari kwiyongera kubera ko harimo agenda hazamo inflation.
Yes, arigenda yiyongera. So what challenge are you seeing? So there is something I skipped which I want us to maybe introduce, the small one. Tuze turangiza saa 9.
Nta kibazo.
Saa 10 ahubwo.
Ariko twabanza tugafata lunch.
Yego rwose niba ari saa 10 dufata lunch.
Dufata akarangi then dusoze saa 10.
Reka turangize saa 9.
Turangize saa 9.
Reka asiganye iminota 45. Ariko iyo minota 45 hari akantu ntashize muri area kwa our starting point on investment. I'm going to pick the smallest topics first. Ziriya maybe zisigayemo zisaba ibintu byinshi cyane discussing ejo. So there's something I didn't talk about, which is lease or buy. I want to introduce that one since we are here. Lease or buy decision. In investment appraisal. Lease or buy decision in investment appraisal.
It is O, but O, not off.
So now if you look at this, we are evaluating to either buy an asset or lease an asset. So what's going to be the basis of the decision to make? Where you are minimizing cost. So whether you are buying, you look at, suppose say you want machines, and you're evaluating whether you should acquire those machines by buying them, or you should acquire the machine by leasing. Now, if you are to make a decision, it's going to be best where you minimize the cost. Where are you minimizing the cost? Are you minimizing the cost by buying, or are you minimizing the cost by leasing? That is the lease or buy decision. This involves evaluating how the entity should acquire assets. The decision is made by comparing the cost of buying the asset, the cost of leasing. Now, when you're evaluating this, what you are looking at, suppose I buy the asset, what is going to be the cost? Suppose I lease the asset, what will be the cost? Now, the important in your analysis is to identify the cash flows. What are the cash flows on purchase? What are the cash flows on lease? Then determine the value. So, relevant cash flows for a lease decision. Suppose you are deciding to lease, what will be the relevant cash flows? Number one will be the lease rental. The lease rental. The money you are going to be paying per year to lease the asset. That's going to be a relevant cash flow for your decision. Number two, a tax saving. A tax saving on the lease rental expense. Please, this only if there is a tax in the question. If there is no tax, it means you will only have one relevant cash flow, which is the lease rental. But in case you have a tax in the question, then also recognize the tax saving on the lease rental expense as a relevant cash flow. So
that is in the case you are given the tax rate like 30% or 10%.
Yes. Now, what will be the relevant cash flow for a buying decision? Suppose you want to buy. You want to buy the asset. What will be the relevant cash flows? Number one, the cost of the asset. The cost of the asset is relevant. Number two, the residual value. Residual value of the asset. That if the asset has got a residual value at the end, that is also relevant. Then we have the maintenance cost. If you are going to, you may find that you are going to be maintaining the asset. Maintenance cost. It's also going to be relevant. Then, still here, I caution you, members, here, the tax saving should only be recognized if there is a tax rate, tax saving, or the tax allowable depreciation. If you have a tax, then you should recognize that. If there is no tax, please don't recognize this. So these are the relevant cash flows that you are going to evaluate to determine whether you should purchase the asset or you should lease the asset.
Sir?
Yes.
Talking of tax, on this decision, means the tax is always given, while in buying it may be given or not.
No. Even in the lease, if you have been given a tax rate, then it means you'll have to save. But on buying, they must specify whether the depreciation is allowed for tax. In that case, you have to depreciate the asset and then recognize a tax saving on that particular asset. Please, it's very important to look at that very seriously. Otherwise, you may end up making a mistake on it. So another important aspect here is a discount rate. Discount rate. So how are we going to discount our cash flows? So the discount rate is going to depend on how the proposal to buy the asset. How are you going to buy the asset? If you're going to buy the asset using a loan, then both the buying and the lease should be discounted with the cost of loan. If you're going to buy the asset using equity, then it means both cash flows should be discounted using the cost of equity. So the discount rate that you are going to use, it depends on how the asset is going to be financed. The proposal to buy the asset. Are you using equity and loan? Are you using loan alone? If you are using equity and loan, you are going to get the wachacha for that decision. But if you are using loan, then you are only going to look at the cost of the loan to finance that asset. I hope I've been clear.
So what if I'm using equity only?
It means we will discount using equity.
Cost of equity.
The cost of equity.
Okay.
So the discount rate to use depends on how the asset will be acquired. If the asset is financed by loan, cash flows
You escaped by.
cash flow should be discounted using the cost of loan or debt. On the other hand, if the asset is financed using both equity and debt, wachacha should be used to discount the cash flows. So please, that is a very important. I've tried to simplify this, to summarize it in a way that it can be easily understood. The way the discount rate that we are going to use is going to depend on how you are going to finance that particular asset. Whether you are using it, you are using equity, you are using debt, you are using a loan. So what you need to look at, what are the relevant cash flows, and then how the asset is going to be financed. Then from there, you can be able to discount. So let's look at this simple one. Then
Excuse
from
me.
yes, some information I've missed.
Yeah, I'm missing information regarding leasing.
I think it is there. It
No,
says the management of the company is evaluating investment in new machines. The cost of the machine is 100 million. Some board members are in favor of leasing the machine in order not to affect the company's cash flow. One bank has made a proposal to lease the machine to the company at 28 million per year for a period of 5 years. Isn't it the leasing?
The next sentence, I think, should be lease.
Huh?
The next thing, if the decision
Is to purchase the asset.
asset.
Yes, if they said that the first decision is to lease, the company will lease it at 28 million per year for 5 years. But if they make a decision to purchase, they will have to borrow money. It means the asset is going to be financed by a loan.
Okay.
Yes. Now, maybe what I've not mentioned in the lease, whether the lease is paid in advance or paid in earlier. We are assuming the lease is paid in the same tax period. Isn't it? That's what we are going to assume. The lease is paid in the same tax period.
Yes.
So then I need the year 6. I don't know where to get it. Year 0. So if you look at the lease option number 1, option 1, to lease the asset. And what do I need in this option? I need the lease rental as my cash flows, which have been given as 28. We are going to reduce 3 zeros. Tax have been given is 30%. And we are saying, we are assuming that the lease is paid at the end. That's when we are going to pay, not at the start. And yeah, starting from year 1. I need to reduce a bit such that I create another space. I need another row here. Ooh, it's not giving me another row, another column. Okay, I needed this one. Hope everything is still in line. Oh, this one has changed.
But no problem, you will share both Excel and the PDF.
And the PDF?
Yes.
Okay, let me see if I can make it. Okay, I think I've got what I needed a column because the lease is paid in advance. I mean so what is our lease rental? We are paying 28 per year. And we are saying, please, if we are paying in advance, it would be starting from year 0. But we are assuming we are paying at the end of the year. So it's going to be up to here. It's a payment, eh? It's a minus, sorry. I think the fingers are starting not to touch. Now, we are going to save a tax, our tax saving. And our tax is paid 1 year in earlier. It means the tax of year 1 will be in year 2. So I have this times 30%. That will be the tax. Now, what will be the net cash flows? Net cash flow. So it will be this is my net cash flow. So I need to get my discounting factor. So what is going to be the discounting factor? Might this going to be my working number, maybe number 1. I need a discounting factor. So what I've been given here, I've been given a pre-tax cost because it's financed by a loan. I have a pre-tax cost of loan, which is 15%. I have a tax, which is 30%. Using what we discussed, this is unfloated debt. So it means my KD will be equal to 0.15 into 1 minus 0.3. And I get what? $10.5. Nivyo say?
Yes.
So it means my discounting factor will be 10.5%. So I can now put in here 1 plus 0.105 power minus, I get that. So what is the present value? My present value will be, get this, times the discounting factor. So what's going to be the present value cost of the lease? Or sometimes they say any PV of the lease, but for I call it a PV cost of lease. I'm just going to add to get the summation. I add from year 1 to year 6. So it means if you are to finance this asset using, that will be the cost. Twageze twese hano se?
Yego.
None option 2. Option 2 is to purchase the machine.